An understanding of tax as a subject, first of all, requires an understanding of the tax system, as in basically how exactly does the entire administrative mechanism work, who all are a part of it, how or what is the basis for the tax law, who is responsible for enforcing it, what happens if you don't follow some of the provisions. So, before we get deeper into understanding of taxation as a subject, we should focus our attention on understanding the tax system, which is precisely what we are going to do in today's discussion. So, basically, tax is how the government raises money to run the country. If you have ever heard the finance minister's speech in parliament, if you have ever heard Nirmala Sitaraman or any other speech for that matter, they always say, or these finance ministers, they always end up saying that, we are planning to grow the country. This is how the development will take place, blah, blah, blah. And this is what we are spending on infra, what we are spending on health, so on and so forth. And then the finance minister says, to finance this expenditure, I plan to levy the following taxes in the economy. So, tax is a way in which the government raises money to run the country. So, the tax that you and I pay, be it GST, be it income tax, be it anything else, the proceeds from that are going for building roads, for building healthcare infrastructure, for basically setting up and running the economy. That is tax. And taxes, for simpler understanding, are of two types. There is your direct tax and then there is your indirect tax. What is the difference between the two? Direct tax is when the impact and incidence of tax is on the same person, which means there is a person called Satyamed. He earns income of 50 lakhs and he himself has to pay the tax. It is paid from my pocket. I am the one who suffers the burden of that tax. And it is going also out of my pocket. The tax is levied on Satyamed and Satyamed is the one making the payment. That is your direct tax. Okay. And what all comes under that category? Income tax, capital gains tax, all of these come under the category of direct taxes. Earlier, we had wealth tax in India. Now we don't have that. There was estate duty. Now we don't have that. In the United Kingdom, for TX level, you need to know that there are two direct taxes that primarily we'll be speaking about: income tax and capital gains tax. Then you have indirect tax, where the impact is on one person and the incidence is on another. Suppose you go out to buy a packet of chips, like right today morning, I purchased a packet of chips, and on that wrapper, they had written 30 rupees inclusive of all taxes. So maybe out of that 30 rupees, 5 rupees is for tax and 25 rupees is the basic price. Now, see, Satyamed is paying 30 rupees out of his pocket. The shopkeeper is selling the item to Satyamed. Satyamed is paying 30 rupees to the shopkeeper. Now, the shopkeeper is depositing 5 rupees with the government and keeping 25 rupees with himself. The shopkeeper is not paying the tax out of his pocket. He is recovering the money from Satyamed and then he is depositing the amount with the government. Who is suffering the burden of tax? The burden of tax is on Satyamed, who purchased the packet of chips. But Satyamed did not go and deposit the money with the government. It was the shopkeeper who did it. So this is a situation where impact of tax is on one person, the incidence is on another person, and such a tax regime is known as indirect tax. Okay, so and what all taxes are covered here in India? You have GST. In so many countries across the world, in the United Kingdom, in the Middle East, you have value added tax, and then there is service. Service tax was there, now it's not there anymore in India. So these are the two primary types of taxes that we can talk about. Now, the income tax system in India, in UK, in almost all countries in the world is basically a progressive tax system. What is a progressive tax system? The tax increases as the level of income increases. In the United Kingdom, the tax rates are, if your income is between 0 to 37,700, you pay 20% tax. If your income is between 37,701 to 125, 140, then you pay 40% tax. If your income is above 125, 140, then you pay 45% tax. See, these tax slabs can change from year to year, but the fact remains that As the income level increases, as you observe, the tax level also increases. That is progressive taxation. What is regressive taxation? Regressive taxation is as income rises, proportion of tax falls. Okay, say suppose there are two girls, Drishti and Sneha, who have purchased iPhone 15 for 1 lakh rupees base value. Okay, now the base value of iPhone 15 is 1 lakh, and on that GST in India is at the rate of 18%, which is 18,000. I'm sure you have friends who have friends or people who have been standing outside the Apple store for the entire night or maybe even longer to purchase a fresh from the oven iPhone 17, which has basically taken everyone's fancy. Now, the reason why I brought this up is, see, this girl Drishti, her total income is 20 lakhs and the GST impact is 18,000 for her because Drishti purchased a phone worth 1 lakh rupees and she suffered GST of 18,000 that went out of her pocket. Sneha's income is 10 lakh. Sneha also purchased an iPhone worth 1 lakh, and how much GST was collected from her? 18,000 GST was collected from her. Now observe, GST is 18,000 in both cases because both purchased phone of the same value. But what is this GST as a percentage of Drishti's income? It is 18,000 upon 20 lakhs, and here it is 18,000 upon 10 lakhs. 18,000 upon 20 lakhs is 0.9%. 18,000 upon 10 lakhs is 1.8%. Now, in an ideal world, see, the person whose income is more should be asked to pay more, suffer more tax. But in indirect taxes like GST, VAT, the person whose income is more is suffering a lower percentage of tax. As you can observe, Sneha's income is lesser, GST forms a bigger proportion of her income. Drishti's income is higher, the GST forms a different proportion of her income. In an ideal world, so we are talking about a situation where a person is whose income is higher, he is suffering a lower percentage of tax as a percentage of his total income. This type of taxation is known as regressive taxation. See, regress is the positive of progress. In progressive taxation, more income means more tax. In a regressive system, more income leads to a lower tax impact. And in certain cases, tax is proportional. Tax is calculated at a flat percentage of total income. Everyone pays the same percentage of tax regardless of the level of income. You will find this in case of companies or in case of corporate tax, where regardless of how much is your level of income, you will end up paying 19% tax. So if somebody earns 100 rupees, that person is going to pay 19% tax. Somebody earns 1 lakh rupees, that person is also going to pay 19% tax. Rate is same for all. It is always a proportion of your income. And then there are certain taxes which are ad valorem. Basically, these are taxes on value addition, something that we'll study when we do VAT. So to summarize what we have covered so far is, we understood what is tax, we understood what is a direct tax, what is an indirect tax, then we understood what is a progressive tax and what is a regressive tax, and then proportional tax and ad valorem taxes. With that in mind, let's quickly again recap why exactly do we need taxes. See, you need funds for running the country, right? That is not coming for free. You have to pay for building a hospital, you have to pay for constructing a road, you have to pay for setting up, even a bridge, constructing a bridge or roads or anything. Everything requires money. And how do you fund that expenditure? By way of taxation. You could levy import duties. I mean, the tariff war between India and US, which is happening right now as we speak, I think it's the very pinnacle of how exports from a particular country or imports from a certain country will be taxed at a higher level, and this is often done to discourage imports. The United States wants to protect its own economy, and what the country is trying to do is, on all exports that India is making, they're basically imports for US citizens, they are levying an import duty so as to discourage imports. And sometimes, you might do something like you will tax imports and you will cancel taxes on exports for the purpose of promoting the exports. And you could also see taxation at a later stage, at a higher level of fiscal policy, can also become a tool for keeping inflation under control. Now, if you want to run the judicial systems, if you want to run the social security systems, you will need taxes. How else will you have the money for that? And in terms of delivering social justice, basically all economies basically work on the principle that charge the richer and use that money to basically help the poorer. So this is in a way a formalized form of Robin Hood where you are taking money from the rich and using it for the less advantaged sections of society. And wherever it's not possible, maybe you could use the same money to provide free healthcare to underprivileged people. So there are many, many such applications and uses of tax. Now, within taxation also, what we are going to study in our UK tax syllabus is we'll be studying income tax, we'll be studying capital gains tax. Now, what is income tax? Income tax is tax on income earned by individuals. Capital gains tax is, see, when an individual disposes of a capital asset, right? A capital asset, we'll see what a capital asset is, but for now, think of it as a long-term asset. Okay. When an individual disposes of a capital asset, he will have a capital gain. And on that capital gain, the government is going to levy a tax, which is called the capital gains tax. There is an inheritance tax also. You don't have this in India, you only have this in the UK. What is an inheritance tax? It is a tax payable by personal representatives on the value of a deceased person. So if somebody dies and the person gives you an estate or the person gives you a set of assets in his will at the time he is dying, that amount is your inherit and that is your inheritance, and when you pay tax on that, that becomes inheritance tax. It's again a separate discussion in your UK tax syllabus. Which is this is followed by corporation tax, tax payable by companies on all the incomes and gains that the company is earning. And you also have national insurance contribution. This is payable by individuals who are employed or self-employed, both of them, and it is calculated on earnings. The money that the government raises by national insurance contributions is used to provide healthcare cover, social security benefits to the public at large. And of course, there is value added tax, which is an indirect tax. Okay, so in our syllabus, we will be studying all of these taxes. And who administers or who is, basically controlling everything relating to taxes? It is His Majesty's Revenue and Customs. When I was studying to be an ACCA back in the day, this was called Her Majesty's Revenue and Customs because Queen Elizabeth II was still alive at that point. Now it is her son, King Charles III, who is the monarch of the United Kingdom, and the government collects money in his name. The king or the monarch collects taxes, and the name of the body is called His Majesty's Revenue and Customs. It is responsible for overseeing implementation of tax laws, oversees tax administration process, makes sure that money is available to fund UK's public services and help families and individuals with targeted financial support. Staff that works for HMRC is called Officers of the Revenue and Customs. HMRC is the board. Like in India, you have the income tax department. There you have His Majesty's Revenue and Customs. Okay. And they are responsible for ensuring that the tax systems work efficiently. Now, how do you know that you have to charge a 16% rate of tax on something and a 23% rate of tax on something else? How do you know that? So basically, the question I'm asking you is what is the source of this tax law? Where do you get the guidance on, okay, this is how a tax law is to be framed and this is how it has to be applied? These are the rates that are used. Where does it come from? See, tax laws come into existence because of certain laws that have been passed in the parliament. Now, who is the supreme lawmaking authority in any country? If you think about India, you have the Parliament of India, which is the Lok Sabha, and you also have the Rajya Sabha. Lok Sabha is, where all the elected representatives by people sit. And then you have the Rajya Sabha, where, you basically have, it is a council of states. It is the upper house. Similarly, in the United Kingdom, you have the House of Commons and you have the House of Lords, the two houses of parliament, lower house and upper house. About any law, for any rule to become a law for the country, that law has to be passed in parliament and then it receives the assent of the president. Similarly, in the United Kingdom, it receives assent of the monarch of the United Kingdom. And once it is passed, it becomes binding on everyone else. And see, tax laws are updated every year in the budget. Now, you don't have a new Income Tax Act every year. You don't have Income Tax Act 1961, 62, 63. No, you don't have that. But there is one income tax law which is made at some point of time. And every year, whenever you have to change the tax rates, this process is done in the annual budget, which is presented in the parliament. There, the finance minister will change the tax rates in order to suit the overall plan for the economy. That is where the statute part comes from, which is basically the law. And we just discussed how that proposal becomes a law. Now, there are so many cases, where uh, there will be a disagreement between His Majesty's Revenue and Customs and between the individual taxpayer. The tribunal or the income tax officer might have a point of disagreement with the taxpayer, and they might ask the taxpayer to pay an additional amount, or they might levy some penalties and fees and all of that on the taxpayer. Now, what you should understand is, see, if, say, for example, HMRC has filed a case against me, or I have filed a case against HMRC, and we reach the court of law. Now, how does the court decide whether Satyamed is right or HMRC is right? What the courts will do is, the courts basically try to fall back on previous case laws. Now, what are these previous case laws? Let's assume that Satyamed is a person who was driving a four-wheeler. This has got nothing to do with tax, but it will help you to understand what case laws are. Satyamed was driving a four-wheeler and he lost control of his vehicle, and his vehicle hit a wall of somebody's house. And because of that, the wall collapsed and the garden and everything got destroyed. And the person's dog, which was sitting right next to the wall, also got killed, unfortunately. Now, the owner of that house, whose garden was destroyed and whose dog was killed, files a case against Satyamay. Now, the case goes to a court of law. In the court of law, this matter is discussed extensively, and the court comes to a conclusion that these were facts of the case, and this is what we have decided. Now, if there is much later, there is a guy called Harsh, and Harsh then, has a similar situation where he also causes an accident with his four-wheeler. Now, in this case, what the courts are going to do is, courts are basically lazy. So what the court will do is, they will see if in the past a case like this has ever happened, which basically had similar facts, quite exactly like this one. And they will examine the facts of that case. They will compare that with the facts of the current case. If they are matching, then they will say, because in the past this judgment was made, we are also making the same judgment again. Don't waste our time. That could be another source of tax law. Then you have HMRC guidance. What is HMRC guidance? See, there could be tax laws and provisions and sub provisions which are extremely difficult to interpret. And in that case, HMRC will publish a guidance note, or they will publish certain clarifications which will help you to understand, implement, and apply law in a better way. Then you have the statement of practice, which is a clarification on how rules have to be applied, very, very procedural in nature. For example, it could contain guidance on how to fill the income tax return form, or how do you fill a form for claiming certain exemptions. So it will contain, the procedural aspects of it. Then you have extra statutory concessions. HMRC cannot counter the law, but where the tax laws are extremely stringent, ESCs allow HMRC to take a more lenient approach and make tax laws slightly less strict for certain taxpayers. So, what HMRC is trying to do here is, HMRC is trying to say that, listen, uh, we cannot challenge the law, we cannot change it, but because your case is not as stringent, your case is not as severe, and the offense not so big, we are allowing you to make certain relaxations when you are applying the law without violating the defining spirit of the law, that is your extra statutory concession. And then HMRC releases a list of such relaxations which taxpayers can follow. Like, in accounting, in financial reporting, for small and medium enterprises, the International Accounting Standards Board has released IFRS for SMEs, IFRS for small and medium enterprises, which are like relaxed versions of the accounting standard. Similarly, this extra statutory concession is a relaxed application of the tax law. Then the HMRC website, leaflets, and publications, and detailed technical guide. Okay, so all of these come together to basically give you the rules and regulations that are necessary to frame the tax laws for everyone else to follow. Okay, so tomorrow, see, this might not be worth 20 marks in your paper, but as students of tax, you should know how tax laws are made. You could get a multiple choice question from this, not too many, but yes, multiple choice questions are quite possible from this part. With that in mind, I would want to discuss two terms with you, okay, which are basically tax evasion and tax avoidance. Tax evasion sounds far more dangersome to me as compared to tax avoidance. The term tax evasion basically means doing any or undertaking any illegal action in order to reduce the overall tax burden. For example, the tax law says that if you pay life insurance premium, then you will get a deduction. You have paid premium of 15,000, but you tamper with the premium receipt, and now the premium receipt shows 1,50,000, and you claim that much amount in your tax return as a deduction. That is tax evasion. You are suppressing information or you are submitting false information, and tax evasion is an illegal activity and carries a risk of criminal prosecution. If the tax authorities find about it that you have done this, it's fraud. It's like stealing something. It's far worse. So if tax evasion is an illegal activity, tax avoidance, on the other hand, is using the taxation regime to one's own advantage by arranging your affairs to minimize your tax liability. Some people might also call it tax planning. Tax laws are given, and there are certain loopholes sometimes in a given tax law. In that case, you make use of those loopholes in order to get away with, something. That is tax avoidance. It is not illegal, and it does not mean you are giving any, misleading evidence to His Majesty's Revenue and Customs. It's basically making use of the loopholes in order to secure a way for yourself. For example, this is one of my personal favorite anecdotes which I have used in my life. Say, for example, I'm I have a student named Elvis. Okay, and Elvis and I have a bet that if Elvis loses, we have some bet. And what is the outcome? If Elvis loses, he has to listen to me. And what happens is Elvis actually loses the bet. And now I'm saying, okay, Elvis, now you have to listen to me. He said, yeah, okay. So I tell him, you know what, Elvis, go to the shop and bring 10 packets of chips for me. And Elvis doesn't go to the shop. Then I tell him, you know what, Elvis, go and get me an ice cream. Elvis still doesn't go to the shop to get me an ice cream. He does nothing that I'm telling him to do. And then I shout at him, Elvis, you promised, you lost the bet. Now you have to listen to whatever I have to say. Elvis says, ah, I'm listening now. I said, but you're not following it. You're not getting me. He said, the discussion between the two of us, what were the terms of that discussion? I have to listen to what you have to say. Nobody said anything about following the orders. Nah? You only said, listen, I'm doing the physical act of listening. So this is a loophole and he's trying to get away with it. That is basically what is tax avoidance. So what HMRC has done is it has introduced disclosure obligations regarding anti-avoidance tax schemes, requiring the declaration of the details of the scheme to HMRC. So it has made certain disclosures mandatory in tax returns, and that is also followed by a general anti-abuse rule. So these are often done to counter artificial and abusive schemes where arrangements are put in place deliberately to avoid tax. If I were to talk of, the UK tax rules, in ATX you will study this. There is something called as gifts with reservation of benefit. Now, that is an anti-abuse rule. What that rule is and all, we'll study that when we reach our ATX level. Okay, so you should know these two terms. Tax evasion is deliberate, willful, and criminal. Tax avoidance is just making use of the loopholes in the law in order to reach a particular safe position for yourself. I'll quickly walk all of you through the fundamental ACCA principles, fundamental ACCA ethical principles, which you will use in your tax exam, but which you will also apply in SBR, SBL, AAA, APM, ATX, every other paper, even the AA paper at skill level, you will be using the five fundamental ethical principles. In tax, they are not so important, but in an audit exam, they are super critical. What are these five fundamental ethical principles? The first one is objectivity, which basically means you have to be free from bias and you have to be impartial when you are dealing with a client. You cannot let your personal feelings or your personal close relationship or any of these aspects overpower your ability to perform your role as a tax consultant. So you have to be free from bias, and that is what objectivity is all about. You should not come under any undue influence or force somebody, forcing you into taking a particular action, which is against the provisions of law. Being the fundamental ethical principle of integrity basically wants you to be straightforward, wants you to be honest and truthful. I think that is the very bedrock on which professional accountants' entire career is built. That they have to be people who speak the truth, they have to be people who are honest, and they have to be people who are they are straightforward. You cannot hide facts. You should not make an attempt to conceal any information. It basically shows your strength of character because you owe it to a larger set of individuals to be truthful in your approach. When I talk about professional competence and due care, the word professional competence means, do I have the technical knowledge and the technical expertise to get a particular activity done? When I'm talking about professional expertise, do I have the knowledge? Say, for example, someone has appointed me to help them with transfer pricing related adjustments in their tax return. Now, I have not had any exposure to transfer pricing work in the past, and yet I am accepting that particular assignment. Is it against my fundamental ethical principles? Ideally, yes, because if I am accepting an assignment which in a subject area that I'm not an expert with, it will I will not be able to do justice to the client and I will not be able to do justice to the assignment. I will end up causing more damage to the client and he will not even get the correct advice from me. And which is where, professional competence is important. And the word due care means doing your job with the same level of focus, with the same level of attention that you would apply when you are working for yourself. I mean, if you're driving your own car, you would be far more careful, right? So when you are driving a car that belongs to someone else, your care, your focus should not be any less. You have to make sure that the work that you do for others is in the same vein, the way you do it for yourself. Then the next principle is professional behavior, which is complying with the relevant laws and regulations and not doing anything that brings disrepute to the profession. Because if you help someone with tax evasion, if you help someone in, concealing certain sources of income, and later on this particular activity comes to light, now will the world will paint the entire chartered accountancy profession in a negative light, that these chartered accountants are enablers of tax evasion, and such an activity of yours will bring disrepute to the profession. So that is something which you should avoid. Then talk of confidentiality. Confidentiality is basically respecting the sanctity of information that is given to you and not disclosing it to anyone else unless there is a legal requirement to do so. This is followed by an understanding of money laundering. What is money laundering? Money laundering is, of course, when you go to professional level, money laundering is going to be discussed in far more detail. But right now, think of money laundering as the act of converting black money into white money. So something that are proceeds of a criminal activity, or something that is basically proceeds of some illegal activity, converting those proceeds of illegal activity into like a legal source of income is what money laundering is all about. Now think of it. Okay, I am a government officer and I regularly accept bribes from all the people who come to me for work. Now, if I deposit that money in my bank account, then naturally the income tax authorities will come after me. Ki your salary is 2 lakh rupees. How come the monthly deposits in your account are above 5, 6 lakhs? They will have that question. So what I do is I open a bank account for my wife and I start depositing all these proceeds of bribery in her bank account. And at the end of the year, I create a fake business in her name, wherein I say that, what, my wife conducts cookery classes at home and she does knitting, stitching, embroidery for women's clothes. And that is how she has earned this much income. So some proceeds of a criminal activity, which was bribery, were converted into were basically converted into a legitimate source of income, and that is money laundering. Now, every company should appoint a money laundering reporting officer within the firm, whose job is basically to be he's a person to whom all actual or suspected offenses of money laundering are reported to. So what this person does is, this person people report to this person if they have any suspicion of money laundering. Okay. The money laundering reporting officer will decide whether a transaction should be reported to the National Criminal Agency. And then, of course, a report to NCA does not remove the requirement to disclose the information to HMRC. It will have to be disclosed to HMRC as well. And where a report is made, the client should not be informed, as this may amount to tipping off, which is an offense. Let's assume that, I know that my client has amassed large wealth through human trafficking and drugs. And now it's my responsibility to report it to the National Criminal Agency. I told it to them, and I told this particular issue to HMRC. Now, after I reported that, something inside me stirred. I called up the client and told me, you know what, these people are going to raid your premises, so you better move your proceeds elsewhere. Now, I should not tell this to the client, because this offense, this activity is known as the tipping off offense. Okay. And that could land you behind bars. So money laundering is basically converting black money into white money. And then there are certain compliances and regulations that surround it. Of course, when we go to P level, we'll discuss this in more detail. And the last thing is dishonest conduct of tax agents. So there is a civil penalty of up to 50,000 for dishonest conduct of tax agents. In cases where the penalty exceeds the minimum penalty of 5,000, HMRC may publish details of the penalized tax agent. It's like, doing a public insult by publishing the names of such agents in the public domain. And with agreement of tax tribunal, HMRC can access the working papers of a dishonest agent. Usually, the working papers of a tax professional, of an audit professional, are their own property. This information should not be disclosed to any, they are not bound to show it to anyone else. But if you're caught within this framework of being a dishonest agent, then HMRC can access your working papers. Okay. This was the basic background of how the tax system is in the UK. Post this, what we'll be starting is calculation of income tax of individuals. We'll learn the basics and then we'll build it up from there.